Hi, this is Bill Prater, and welcome to the Business Builders Show, where we feature champions in their respective industry from all over the planet. Our mission is to provide you with timely, provocative, and actionable resources that will inspire, promote, and accelerate your quest for business excellence. Today, we're going to find out how to build a real estate empire one deal at a time. And Michael Pouliot will walk us through how to do that. Now, Michael's the CEO, founder of EON, which is a technology-driven real estate firm. Plus, he's the CIO of Carbon, which is a middle market private equity company. He's got over 15 years experience across finance, consulting, and real estate. He's also the fourth generation real estate entrepreneur who started on job sites in middle school. He holds a CFA and a CAIA charters and studied finance at Boston University. He's overseen more than 400 million in housing and related deals over 1 million square feet of office and mixed use projects. In addition to that, he hosts the Deal Flow podcast and provides free resources for aspiring real estate entrepreneurs through his Deal Maker Fast Track community. Michael, it's a fantastic to have you, sir, on our show.
Thank you for having me. I'm tired just listening to my bio.
You've got an interesting one. We want to find a little bit more about that. Starting with, Michael, who do you and your firm serve?
Sure. Yeah. Thank you for that, Bill. We're really about serving a few different groups of folks, depending on where they are in their journeys. So starting with the bio, the end of the bio in mind, the Dealmaker Fast Track is really supporting folks that are at the beginning of their journey, trying to figure out where they fit within the real estate landscape. Do they want to be deal makers? Do they want to be lenders? Are they going to do fix and flip, et cetera? We help them really understand their investing philosophy and what they're going to do in the real estate world. And then we teach them whatever that is, whether that's single family all the way through commercial, whether or not they're going to raise capital, they're going to do deals on their own, all that sort of stuff. And then all the way on the other side of the spectrum, through the PE firm, we serve two primary folks. We've got our investors. Obviously, we're primarily buying middle market deals, as you said. That's $10 to $50 million. We capitalize those deals with family offices as well as high net worth individuals and some institutions, insurance companies. And so we serve the LPs in that capacity. And the other side of that is, of course, our residents. So we own or operate all of our properties. We're vertically integrated. We really think of, if we can take care of the residents at our properties, they take care of our properties, they pay rent, they stay a long time, and then they pay the cash flow out to the LPs. So it's a symbiotic relationship between us, the LP, and the resident, and we see it in that kind of a triangle. So those would be the main people that we serve through our various endeavors.
So, Michael, what are the typical problems that you're solving for these various avatars?
Yeah, so going in the same order, for the newer investor, I think a lot of people are looking for financial freedom, time freedom. They're trying to get out of the W-2 or the rat race, the week by week check, living paycheck by paycheck, and they see real estate as that avenue to get to that vision or that dream. And so what we try to do is help them realize that dream, that vision, and bring them from whatever they're doing, whether or not they're in a blue collar position, they're in a trade of some sort. That's where we see a lot of people coming who are already involved in the real estate space, but they're more on the labor side. And we figure out, how can we help them become an asset owner? How can we help them leverage all the experience they already have physically with the assets and leverage that more on the investment side? And then for the other folks, maybe engineers or software engineers or actual engineers, lawyers, a lot of professional services folks who are just trading time for money. They're making a lot of money per hour. They're also seeing what's going on with AI, and they're wondering, hey, am I going to have a job in the 2030s as a lawyer, as an engineer? And so they're wondering, how can I start to build an asset base that can pay me while I'm not working, or while the chat GPTs of the world are doing the work for me? So that would be how we're helping those folks. So far as on the LP side, they're mostly looking for a few different things. Depending on the type of LP that we're talking to, they may be most concerned about taxes. So tax mitigation and shielding is really important to a lot of LPs. Maximizing their after-tax returns is really important through bonus depreciation or cost segregation studies, those types of things. We certainly have a lot of benefits within the real estate space for that, as well as cash flow. Especially when working with family offices, they're mostly trying to match their assets and their liabilities from what are their funding needs on an annual basis, their the education needs of their grandchildren or the generations below, and how do we help them solve those challenges through high yielding positions in our real estate deals. So I would say cash flow, tax benefits, and then always asset and equity preservation is always number one. So we definitely want to make sure that we're never in the business of losing money. And so number one rule is always protect the principal. And then the last thing I would say on that is people, of course, want capital gains, right? Over time, they want to see that principal balance accrue. So it's not just about getting cash flow, tax benefits, and protecting principal. People want to see multiples on investment capital over time. We look at our investments as long-term investments. We hold for at least 10 years in everything that we're doing. So we expect to provide not just the cash flow along the life of the investment, but when we ultimately return that cash or 1031 in the next deal, we're providing our investors with a good internal rate of return.
Excellent. I like the way you went through those in order. Maybe just one example, but maybe you could tell us how you go about solving those problems. Maybe take a project from start to finish. And I realize you probably haven't sold any yet, but walk us through how your business operates.
Sure. Yeah. So I think the easiest one is probably on the private equity side, the larger transactions. So I lead the acquisitions and the deal making side of the business. My partner is more on the operation side. So it's really easy for me to walk through the deals because I'm the one who sees them from the front end and he needs to worry about them on the back end more than I do. We have a process. We process about 2,000 to 2,500 different deals a year through our team. And then once we get them filtered into our business, we'll underwrite about 30% of those and really dive into the data. And then ultimately make offers on roughly 300 of them. So that 2,500, we underwrite about 600 and then ultimately make about 250 offers. Of those, about, I'd say 20 to 30 they'll be very competitive. We'll have the opportunity to win those deals. And then we'll end up closing on 4 to 6 of those a year. So it's there's a lot of sifting through the sand to get to the goal that we need to get to. So once we find those opportunities that we like, we have a investment committee process. We have a pretty significant due diligence process. And a typical deal for us might be a 70s to 90s construction value add deal. So we're looking to buy properties in great school districts with low crime that happen just to be older. So they're not going to be the podium style properties with elevators and brand new double, triple class A kind of thing. But we believe that families are looking for great places to live. They want to put their kids in great schools. They want to be in places with low crime. So we really look for the type of assets that appeal to those folks, families who want to live in good locations with great schools and provide a great future for their children. And we believe that those types of families stay longer, they treat the properties well, and ultimately the value of those properties will maintain because the value of the area is very high. So we may be talking to a family where a resident of ours might be making $60,000, $70,000, maybe even 50, but the income of the area might be 100,000. And they may be paying $1,300 or $1,400 rents, where we know that the brand new construction product might be closer to 3,000. So we've got a lot of margin of safety on our rents. We feel really strong about our markets and our submarkets because we're looking at 8s and 9s out of 10s on the schools. So that's like our general screens for how we think about deals. We'll then find the opportunity. we've done a couple opportunities in the last 12 months in the Birmingham market, in a market called Hoover, Alabama, which we really like. A lot of great schools and great dynamics going on there. Not a lot of building, not a lot of supply issues, which has definitely been a challenge in a lot of the other major MSAs around the United States. And so we'll get into the deal once we've done our work, we've done our due diligence, our physical walks, walked all the units, done our vision planning, and understood what we're going to do with the property. We'll get into it. It'll take us about 12 to 24 months to turn over all those units, do the physical improvements, add the amenities that we want to do, deal with any deferred maintenance. And then at that point, if there's an opportunity, we'll do some sort of cash out refinance. But again, the goal is to hold the property. So we're just really returning some capital to investors and then holding for the long term, maximizing the cash flow on that property and enjoying that, and investors enjoying that for many years to come. So that's how most of our deals are executed. We always go with long-term fixed rate debt. That does change. Our leverage point definitely fluctuates based on how market pricing is and where debt is, but we feel that we don't want to be a forced seller necessarily when the market turns. And so we want to make sure that we have at least a 5 to 10-year runway on our debt. And we're typically not exceeding 65% loan to cost on our projects, again, just to maintain a good margin of safety.
I'm curious, do you typically mobilize your investors on a deal-to-deal basis, or do you have a pool of some sort?
So it's a combination. We have a fund that will participate in each one of our deals. Usually takes up about 20 to 30% of the capital structure on the equity side. And then the balance of that we will raise that on a deal by deal basis. Most of our deals are between $7 and $15 million so far as the equity check. So the fund will then get some diversification over a couple of years of vintage. It'll have 5 or 10 assets in it. And that's a great option for folks who are willing to go in blind into deals, because we don't declare what those deals are in ahead. But they want the diversification across markets, across vintage, whereas there's always another group of people who prefer to know what they're getting into. So we try to provide both options depending on the type of investor that we have interested in.
Okay, great. Thanks for that. How are you different from your competition out there in your space?
Yeah. So I think there's two big things that make us different, or two primary things. One would be that we take a very long view as it relates to how we buy property. And I think in this space in particular, especially in the last 10 years, I think people have really looked at buying and selling real estate almost like buying and selling stocks, or a churn and burn model. Everyone wants to get in and out in just a few years. And I feel like that is really just serving, don't want to tarnish anyone necessarily, but I think that really serves more the GP than it does the LP. And I think most LPs, at least the ones that are attracted to our opportunities, are looking to put money into deals and not have to continually put money into new deals every 3 years. And so there's complexity to that. You always have to find new opportunities. There's also a tax cost of that. So a lot of times when you're going to these deals, people are executing these transactions for the tax benefits. But if you go ahead and you sell in year 3, you've got a lot of recapture to deal with. So you end up putting a lot of burden on your LPs to try to solve tax problems, more tax problems than they wanted to solve when they initially invested in the deals. So we take a long view for a number of different reasons. It definitely, in our view, helps the LP. It also helps, from our perspective, maximize the long-term IRR of the deals or of their dollars, because they're not having to go back into cash 3 times every 10 years. And I think people miss that, where on the pro forma, it may say, oh, you're getting a great return. But if you're recycling out of your deals every 3 years and you're going to cash, unfortunately, that P&L, that pro forma, doesn't account for that. We really try to look at the long view. And that's all one of our core values at the company, is taking the long view. That also comes into play with everything that we do, not just the length of our. The second thing that I think is something that we think about at our small size, given that we're under $1 billion in assets under management, I think we take a more of an institutional approach than a lot of other folks that I see in the sub $1 billion asset AUM space. Primarily, I came from the institutional world. I started my career on Wall Street, working for JP Morgan on their trading desk, and then moved into financial consulting. And so spent a long time creating investment processes and being part of investment processes that were built on decades, or if not centuries, of learnings. And so we really took that into the company and tried to apply that from day one. And I think that makes us a little bit different than some of our contemporaries.
Okay, beautiful. Thank you very much. So let's talk about your entrepreneurial journey. So, what were the major milestones as you were going about building your company? I'd be curious to hear about when did it start? How did you decide to have a partner, at least one partner, and walk us through. And as you're doing that, maybe you could attach with each milestone the lessons that you learned along the way.
Yeah, okay. That's a multi-pronged question there. I'm gonna have to. I should almost gotta write that down. All right, so we'll start from the start.
Okay.
Then, so as I had said, I started my career on Wall Street. I think when I was going through college, it was before, but not before the technology was as sexy. Maybe I don't know. Maybe that's the best word to use, but everyone wanted to be a software engineer at some point. But before that, everyone wanted to be, at least growing up in the tri-state area, a banker, work on Wall Street type of thing. At least that's what I wanted to do. So that was what I looked for. So that's why I got my degree in finance, went into the analyst program at JP Morgan. There wasn't many of us. This was post financial crisis, so there weren't many of us in those programs at that point. And then worked really hard. I was working 12-hour days and also commuting from the Princeton area, which is about a 2-hour commute. It's like a car to a train to 2 subways to get to Midtown. So it was tough beginnings, but learned a lot during that time. I think the biggest lesson I learned during my banking years was my managing directors would say, first of all, anything can be accomplished in one day. I think that's a really interesting thing, that anything in your control can be accomplished in a day, because you really had no choice. No matter what was assigned to you, it was due the next day. Anything can be done in a day. I don't know any other way of saying it. So that really gives you a confidence level that I think other people can get overwhelmed with that level of maybe accountability or requirement. The second thing was an intense level of paranoia. So this was something that my MDs would always talk about, is we were client facing. And so it was very important that there was never a mistake. And there was a rule where you can make one mistake in front of a client, but the second mistake, you'd be fired. Luckily, I never made that second mistake. I did make one mistake once early on, and I still almost have nightmares about it. So that level of intense paranoia, I don't know if that's a good thing or not, but it certainly develops you into an analyst. The analyst mindset of having that intense paranoia, triple checking everything, having a maker checker system, and we really take that through to how we do business now. So moving from the beginning of the career, at that point, my fiance, now wife, we have 3 kids now, and we don't live in the tri-state area anymore. But I moved. We wanted to start a family, so I went ahead and I moved into financial consulting, thinking that would be easier or less hours. But it was certainly local, so it was in the Princeton area, and primarily I was helping private equity firms, BDC firms, business development corporations, and family offices understand their investments, which you'd think that they would understand their investments, but a lot of times they invest in things that are actually quite complicated. They don't really know what they're invested in. And we would come in and help them understand it, especially when things went wrong. So when things start going wrong, you have to take a deeper dive into the understanding what securities you actually own and what you can do with those positions and how much leverage you can extract from that position if you wanted to do a workout or some sort of restructuring. So we would help companies in that capacity. And what I learned there was I got a really probably covered hundreds and hundreds of different companies across a number of different verticals, from oil and gas to early stage biotech to light industrial companies to the startups of the world like Uber, as BlackRock was one of our clients. So when Uber was the Uber deal that hit 100 billion, that was a big deal at the time. Now 100 billion is no big deal, but all those different deals, the Canada bankruptcy where it was split up between US and Canada for Staples, that we worked. So a bunch of different deals, both names that you'd heard of and mostly names that you wouldn't have heard of. So there I really learned just a variety of different business models and how those different business models work or don't work. And some business models always fail, basically based on how they're structured or just based on the underlying business environment that you're in. So you can always count on certain business models failing over a 20-year cycle at some point based on where we are in the debt cycle or where we are in the economic cycle. And those business owners didn't necessarily have that context because they were just in that business their entire life and they experienced that boom and bust. And so I think the lesson learned there is really looking at market cycles, looking at the business models and understanding how to match cycle to business model, and knowing that there's some business models you just shouldn't do. Don't need to get involved in those. And then there's some business models that you want to avoid during certain times of the cycle. And then I think the last thing that I learned there was that with operating businesses, you can go to zero quite easily. Very easily, especially if there's no fixed assets or plant or equipment, you very easily have no collateral of any sort, and the business just goes out into the ether and you've got nothing. Whereas with real estate, you at least have some sort of collateral that underlies the valuation. And so I think that was always something that really helped, especially when we were doing workouts. We were always looking at what does the liquidation approach give us? Like how much value do we have relative to the enterprise value if it's a going concern? So that was another one. So that was actually not easier though as a job. It was not less hours. It was still working with clients a lot and being paid by the hour. So while I was doing that, we'd had our first child, my wife, and I really wanted to figure out how could I detach my time from getting paid by the hour. And that's when I said, hey, I should start looking at real estate, passive income. How can I rely less on my labor to make money? Or at least can I do some labor now and then make money forever rather than constantly be doing labor to get money? So that's when I started buying real estate. Started in 2000, bought my first single family home, $25,000, put $20,000 into it, refinanced it for $125,000, pulled out all my money and said, wow, this is easy. Let's do it again. And this was the time when rates were low, bank appraisers were kind, you could get away with a lot of different stuff. So I just said, hey, that's a model. Let's just crank it up and do it as much as I can. So I used a HELOC from my house and I did that 50 more times over the next 18 months. And then a few deals couldn't get all the money I wanted out. And I said, okay, I got a lot of these properties. The money's stuck in them. That's great. They don't make actually a lot of money in cash flow, maybe $100, $200 each. But now once I pay my bookkeeper, that's gone, even across 30, 40 of these properties. And so I said, I need to figure out how do I go from single families where I'm working a lot on each individual project. I was also having to do a lot of running around, dealing with contractors, wire money over here, sign this document, get the notarization done, blah, blah, blah. So doing a lot of little projects. I said, let's just do bigger projects, do less of them, and then figure it out. So that's when I started to buy multifamily, start to partner with other people, started a JV with individuals, ended up finding some folks that some family offices that then backed me to buy a property in the Midwest. We ended up buying a couple $100 million with apartments there. There's some more of the story there, but I spent a lot of time going through the beginning. So I'll speed up a little bit here. Ended up buying a couple $100 million of the property in the Midwest through a partnership, supported by a family office. Eventually they had enough allocation in real estate and they didn't want to invest anywhere else and they didn't want to raise outside capital. So we were in a position where if I wanted to go out and do more deals, I had to figure out, okay, well, I can't really do it within this structure. And also in the mid 2010s, raising money in the Midwest was not in vogue. It was all about the smile states, the migration trends, the Southeast, the Southwest. Of course, now everyone, I feel like, is going back to the fresh water of the Midwest. The thesis that I was trying to push then, people are getting on board for now that I've moved to the Southeast and the and then from there, so now I was like, hey, I got to go find a way to do deals in other parts of the country, expand my capital sources. That's when I met my current partner, Cody, who runs the operations, as I mentioned before. And we have purchased a couple $100 million of the real estate, 10 to $50 million vintage apartments, value add, all the same stuff the whole time through. Since I started, it's always been about buying existing assets, doing some sort of physical and operational improvement, and then bringing it to its highest and best use, maximizing the yield, and then serving those investors and those residents through that effort. And then in 2024, our big project was we decided to go from third-party management to in-house management. So that was largely what we accomplished last year. We did buy a couple deals, but we decided to slow down deal making. Deal making was a little bit stale these last year or two anyway. So we said, hey, while deal making is a little tough, let's build up our operations, let's hire our staff, and let's get all of our properties under our own control so that we can maximize the performance and prepare for the next bull market.
Excellent. So what would you say is holding your business back right now?
I don't know that there's anything holding our business back necessarily. I think with real estate, or I think with investing generally, it's just you don't want to force it. And so we have criteria. We want to do certain types of deals. We have certain return requirements, certain location requirements. We have more money than we have deals. And I think that's the place that we've been working on getting to over this last 10 years. Is it was previously deals were more deals than money, and then now it's definitely more money than deals. And I like that position. It allows us to be tactical in the way and strategic rather, in the way that we do things. And so if we can buy 2 to 4, maybe 5 deals a year every year, and for the next 50 years, then that feels pretty good to me. So
Excellent. Excellent. So I know that you've got a free resource that you've thought about for our listeners. So tell us, one, how can they contact you? And then two, get their hands on that resource that you've thought about.
yes, we have a school community, which is absolutely free. People can just, I'm assuming probably in the show notes here,
Right.
there'll be a link to that school community. It'll go right to our about page, and you just join that community. We just ask for your name, your email address, and your kind of experience. And then that's the only information. That's the trade. The trade-off is that we get your name, your email, and a little bit about who you are. You come into the group. Inside of that group, we have a ton of resources to get you how to develop your business plan, how to find deals, how to analyze deals, how to exit profitably from deals, from single family, commercial, fix and flip, rentals, if you want to flip contracts, anything in between. We also provide live calls on a regular basis. So every week we're doing Deal Flow Friday calls. We'll review actual deals that get submitted by people to our deal desk, as well as the deals that we're working on. We also have Q&A calls throughout the week, sales calls, so people can understand how to talk to sellers or how to talk to brokers depending on if they're going B2B or B2C. So there's basically everything you would need to get off the ground and start your real estate business is right there, from even starting your LLC or building your CRM out or integrating technology. It's all in there. It's all absolutely free. Our view is that we're in an age where information is not gated or shouldn't be gated. It's available. And so we're just trying to put it all in one place and create a community where we can all support each other and ultimately do deals together.
Excellent. That's fantastic. It is a super generous trade. Now, I'm imagining maybe there's a question that I should have thought of and didn't. So, what is that unasked question, Michael, that in your mind that should be teed up and then answered that our audience would say, wow, that was great. So, what's the question? What's the answer?
you're just full of these questions that are you put it on me here. I guess if I said what do you one question I like to ask sometimes of people is who are experts in verticals I don't have a lot of experience in. You have experience in this vertical, but for the listeners, is what keeps you up at night? What are you worried about over this next 12 to 36 months as it relates to your expertise? So maybe that would be a good place to go. Now I have to think of the answer, but otherwise, you want to do that?
Yes.
Okay, we'll do that. Okay. I'll stall here for a minute while I think of my answer. But no, okay. I would say for the real estate business in particular, I think that the thing that I guess if nothing keeps me up at night, I'm actually quite a deep sleeper. And so when like I said, I have 3 children and they're all under the age of 8. And so when I can get my sleep, I get it. But if metaphorically speaking, I would say the thing that probably is most concerning to me would be the debt, the U.S. debt, and I think the implications of that. And as it relates to the 10-year treasury, for me, the number one, the thing that I look at, I don't look at the S&P, I don't look at the NASDAQ or what the VU is doing. I want to know what's going on with the 10-year treasury, what's going on with the 2-year, what's going on with SOFR, because those are the things that benchmark relative to the debt that I take out. And real estate, it can be thought of as a combination of a piece of debt and a piece of equity. You can synthetically put those together, and that's basically where you are. So there is a beta, there is a reaction function that occurs as rates move that affects real estate in a lot of different ways, not just the price of our existing assets, but the cash flow, the appetite of people to buy real estate or to invest in real estate. And then I think more so than even the absolute levels of rates, the volatility of rates can be very difficult for deal making. If you have rates moving, which is happening right now, 50 to 100 basis points potentially up or down in a 30 to 90-day period, it can be very difficult to get these transactions closed, because unlike stocks that can settle instantly or bonds that can essentially settle instantly these days, real estate takes quite a while to settle. And so it might be a 90 to 120 days between the time where I strike a price and I close. And so to have that kind of exposure is very difficult, and it's difficult to keep buyers and sellers together. It's difficult to get to the beginning part of that phase right now where there's a bid-ask spread between buyers and sellers. But once you're under contract, rates moving more than 50 basis points is usually enough to kill a deal if it goes the wrong way. Now, there was a time when rates were moving down and I was loving being in contract because I had a great price, and as rates kept moving down, it was getting better and better. Now it's a little bit of a mixed bag. Rates are going up and down all the time. So I'm concerned about that. And I'm concerned about how the US government continues to spend money that they don't have. That's effectively our money on things that we don't need, or at least could be questionable as to whether or not we need them. And without getting into any politics about it, I think it's just really it's a problem of overspending in my view. And as a result, the market is telling us, and the market's telling us that we're overspending. So as a result of that's something that really, and it's not much, I don't have a lot of control over that. So I have to exist in that environment, do our best to protect our existing deals, make sure, like I said, to take out fixed rate debt. So when we are in transactions, we're not dealing with movements in rates that affect our existing assets, because that can be a real problem. Since I've already locked in my basis, I got problems then. We do things to mitigate that risk, but I think the biggest concern is really around the deal making, being able to get into deals and feeling comfortable that we're able to transact and have a normal liquid market. That would be the number one thing. As a deal guy, I want to keep deals together. I want to get deals done. And that would be the thing that I'm most concerned about right now.
Oh, that's fantastic. Michael, thanks for that question and answer. Thanks for sharing your time with us today. I enjoyed it immensely, and I know our listeners did as well.
Great. Well, thank you. Appreciate the time.
Everybody, in closing, let's focus on the single fact that businesses do not become extraordinary in a single moment at all. Michael covered that pretty hard. Instead, they get there as a result of the owner having a visionary strategy Number one. Number two, executing that strategy with a management system. And number three, leveraging high performance teams. Now, you can get the answers how to do all of those. Go to one of my websites, specifically Business Mastery Pro. That's businessmastery.pro, and you'll get all your hands on all of those for absolutely free. So thanks for listening. Michael, once again, thanks for sharing your time with us today.
Thank you, Bill.